Hi, good evening, Tanmoy. How are you doing?
Hey, hi, Prateek. I'm doing good. I'm doing good.
Great.
How are you?
Good. Thank you for joining in. Tanmoy, great to have you here.
Thanks a lot.
Just to introduce Tanmoy to everybody, Tanmoy comes with a lot of years of experience as a credit risk analyst, as a credit risk modeler, as an expert in the credit risk analytics industry. He started his journey as an academician, and then he moved into banking firms, consulting firms, variety of large consulting firms and banking firms he has worked with, mainly focusing on the quantitative risk analysis side of it. So we thought the ideal thing to do would be that a lot of our viewers, a lot of our learners, they want to understand about different applications of analytics and data science. So I think you bring in great expertise in the area of credit risk analytics. So I just wanted to start my discussion with you with a very simple question that how did you decide to go into the such a fast-paced, aggressive financial or consulting industry from being an academician, a successful academician that is. So how did that journey happen? I'm sure it happened a lot of years ago, but how did that happen, Tanmay?
Yeah. This has been a very interesting journey, Prateek. So basically, the way my academic credential stands, uh, I was someone who was absolutely specialized into core theory. So I
Mhm.
had game theory, mathematical economics as my specializations, and I used to teach. So in my academic days, I used to teach microeconomic theory and mathematical economics. So I
Mhm.
was kind of within this mostly within this purview of the core theoretical economics, and that had been my specialization.
Yeah.
However,
Yeah.
things had changed a lot around 2008, right? So with the 2008 financial crisis coming in, we could see a lot of these regulations being published, Basel coming in, and then people talking about stress testing, and you follow the social and you get to a greater exposure with social media as well, right? You get to see a lot of these information. Obviously, being a practitioner into economics, I was kind of interested into these financial linkages. And also at that time, I was doing my MPhil degree, and doing my MPhil degree was like, I was working on the financial markets, asset price bubbles, and that's where a lot of interaction with data happened.
Yeah.
So ideally, as a student, you are mostly into theory, and as a practitioner, I was also practicing a lot of theory. So with this interaction with data, right, and I got an opportunity to explore these data sources, the different kind of data, financial data, time series data, panel data, and that's where I felt that there was this industry which was actually growing rapidly. Now, when you are actually moving from a theory, or when you're developing a new interest towards something new, you tend to interact with people, right? And similarly, I had the opportunity to interact with very ace industry professionals at that point of time, who were at that point of time 10 plus years into their respective area specialization. And that's where I felt that there was this particular domain called analytics. There was this analytics, and so at that time we used to call it predictive
And you're
modeling
talking
and
about which
analytics.
year? Which year is this?
This is around 2014.
Okay. Okay.
So data science was still not the term that was going, that was not the
Good.
buzzword at that point of time. So we used to talk about predictive modeling, analytics, and so on. So that's where I started exploring this, and I really felt that it could be a area where you have a perfect blend of the real world problems along with these theory of with this economic theory. Now,
Absolutely.
if you remember, at that point of time, we had these stress testing regulations coming in. So the
Yes. The
role of macroeconomic variables were also coming in very
right. Right.
fast at that point of time.
Yeah. Yeah.
So, so that was a part which had intertwined with what I was doing previous, and I really felt that, okay, hey, look, if this is what macroeconomics is, and this is how the real world looks like, and this is what stress testing is, then this is something interesting. And as
Interesting.
such,
So
I started exploring, and then luckily I had kind of moved into financial services analytics.
absolutely. So interesting. I mean, from being an economic student to an academician, a theorist, and then from there to a very, very practical world where you have to quantify each and every risk, and every equation on a model or any suggestion that you make has a great financial impact on the company's performances. So very interesting story there. And Tanmay, as you rightly said, there was a time when I remember for a large consulting company in mid 2000s, we helped them build a large team of 250 plus credit risk analysts, and that happened because of those regulations that came after that financial crisis that we had in late 2000s, right? And a lot of financial regulations came across the world, and all these too large to fail banks, came under the purview of these stringent, quantifiable
Yeah, so
laws.
this concept of globally systematically important financial institutions were coming in at that point of time, given the extensive impact that those two banks had left on the global economy. Because after 1929, that was perhaps the most, that was the, so like if I remove this current pandemic situation, so from financial factors, right? So 2008 financial crisis was a major landmark which had kind of just crashed some of the existing beliefs of the
Absolutely.
financial world.
I remember
To manage
exactly.
that, to harness that,
Yeah.
so that entire, and what was most interesting at that point of time was, so if I say 2014, so you were using data at that point of time from 2007 to 2013, 2014. So you could see the massive impact that those crises had, and that was a time when your regulations were also undergoing a change. So if you think of the US markets at that point of time, right? So they had this fast, so the first of all, the impairment models at that point of time, they were backward looking models, they were adaptive models. But at that point of time, they started thinking about forward looking models, about which whose most advanced form today is a CCECL model or IFRS 9 model that we talk about. But at that point of time, we had the financial accounting standard boards, the FASB, the FASB regulations. They were talking about ALLL, allowances on loans and lease losses. And
Tanmay,
what they were doing was they were, yeah.
if I may ask you,
So
because some of our viewers may get a little confused with some of these terms. So I may ask you, since you're an expert in this area, so what do you think? How would you define credit risk? Just the phrase credit risk to somebody who's completely new by to this industry. Then we'll go to the different regulations, the models.
yeah, yeah.
Because
So
I know
before
you're
we go
very
to the
well,
regulation side,
you really get into it, but yeah.
right, right. Yeah. So credit risk is see, if I'm very simply defined, right? So credit risk is the risk which is arising from credit. The term is so self-explanatory, right? So basically, there is this person. There is a person who needs some funds for some reason. Let's say for buying a car, for investing into a business, creating a shop. They go to the bank. The bank gives them the money. Now the question is that, will this person return the money back or not? So the moment I'm giving the money to this person, so my expectation is that at the end of the year, this person will pay the back of the money along with the interest back to me. So the the very fact that I'm not sure whether this person can give the money back to me or not, that itself is a source of risk. Now, why is this a risk? Because the money the bank is giving out is the depositor's money. So I have kept my money in the bank, and there is some person ABCD who is using that money for some other purposes, and thereby generating some income, and bank is generating an income. So the risk itself arises from the fact that the type of that person is absolutely a private information. So
Right.
the other person knows that whether he is a good or a bad borrower, whether he plans to flunk it or not. But the bank doesn't truly know that. So that is where the risk is arising. And the entire job of a credit risk management, of credit risk management, or of a credit risk modeler is to identify those factors which can help the bank frame an idea about that person's type. So is he a bad borrower or is he a good borrower? Or what are the chances that he is a bad borrower, or what are the chances that he is a good borrower? So that is something that this role of credit risk
Okay.
modeling
Very good. Very well.
actually, or credit risk management aims to do.
Absolutely. So tell me one more thing, Tanmoy, here. What kind of companies hire for such a position? I know you've been talking a lot
Now,
about banks, but what kind of other companies would hire for credit risk
So
analysts?
obviously, yes, obviously one is the captive banks. They are the major recruiters in this case.
Okay.
Apart from this, there is so obviously yes, you have the consulting houses, the consulting houses who are specializing into risk management, credit risk
Okay.
management, market
Okay.
risk management.
Okay.
So
Like Genpact, the
they have
world,
this.
Accentures of the world.
Yeah, you have the Genpacts, you have the Accentures, you have the Big Fours, you have the McKinseys, and anyone and everyone who is trying to, and
Work with
the
central
business
bank.
of risk is the safest business today,
Yeah,
because with the way the risk scenario is, obviously credit risk will be at the top priority.
absolutely.
So if you are
Especially
actually
because of the
into credit
pandemic
risk,
that
you're
we
on
are going
the other
through.
side of it.
Yeah, yeah, yeah.
Right.
So whoever
So
said that,
every time that,
every risk has an opportunity as well, or every setback has an opportunity. So I think that's what you
absolutely. So
capitalized
it's
and said, right? Because of the 2008, a lot of laws came, a lot of countries became very stringent against these large banks, and that's gave a birth to credit risk analyst roles, right?
correct.
Okay.
So the roles were also there previously. It was not that the roles were not there, because I knew a few of the people who were working, like when I was in my school or college days. But the role gained a tremendous extent of prominence after the 2008 financial crisis. And I believe with this current COVID crisis, things are even going to, demand is really going to increase
Become more
currently.
important, I think.
It's going to become more and more critical these days.
Okay, very good.
And
What?
nowadays, you are not only talking about credit risk, but now along with credit risk, you're talking about different kind of other risks. Like
Okay,
let's say
like
one of the is a climate risk.
okay.
You are talking not so previously we used to say that okay, risk has three broad classifications. So one of them is your credit, the other is market, the other is operational. But now there's so many kind of other kind of risks that you are talking about. The banks are trying to like kind of hedge their portfolios against. They
Yeah,
need to take in. So now let's say a risk like this COVID risk,
yeah.
COVID-19.
Right,
Now,
right.
COVID-19 is going to have a tremendous impact on all kind of functions that a bank was actually ideally having. Right. So you need to manage these kind of risks as well. So it's no more limited to the human beings. It's also now nature is also playing a part into it.
So let me ask you, Tanmay. So what kind of skills do the companies look for when they actually hire somebody for a credit risk analyst position?
Now, obviously, if you are so it depends the level which you are hiring, right? So there are some fundamental skills which
So
always
entry
happen.
level, how does one
So
start into
just
this?
at an entry level, if you are looking to explore the domains of credit risk modeling and validation, especially if you're looking to focus on the quant side of it, then one of the most important things is that your quant side has to be absolutely sound.
So
So
quant
you
meaning
must know
statistics,
your
right?
basic. So when I say yes, so obviously statistics is one of the domain, econometrics is one of the domain,
Okay.
and to some extent mathematics, because these days we are mostly into the like we are kind of moving heavily into machine learning
Yeah,
and these advanced statistical methods. So over there mathematics becomes a very important factor
yeah, yeah,
in developing models, because it's not only about developing them, but it's knowing like what exactly lies underneath. So it's also about harnessing those methods, not only just going and developing them. So mathematics, statistics, and econometrics, these are the three most important things that
okay,
a guy at an entry level must know.
okay. So tell me
Now,
one more thing. When we had this consulting company, 4 or 5 years ago, to build a large pool of people, we saw them hiring uh, commerce students as well. We saw them hiring MBA in finance as well. We saw them hiring masters in finance, economics, engineers, all these kind of people, MComs, all these people they had hired from across the India, across the country, and then they had given to us to train them on various credit risk analyst, modules and so forth. So I want to ask you, can a non-econometrics person still make a career in as a credit risk analyst or not?
yeah, obviously they can make. So I would not. So initially, when the industry began, or when this particular stream of hiring had happened. So initially, if you see the people, so people who are now have like who are the seasoned professionals now, So you will see them, they belong to a very common pool of mathematics, economics, and statistics.
Yeah, yeah.
But with time, as knowledge, so as it became more and more common knowledge, so you had people from other streams also coming in, other people venturing in, because it is very it is really difficult if you just stick only to a certain pool of students for your resource base. Because if you think about an economics, mathematics, statistics base, it's a very small base of the overall students.
And
So
the
you
demand
do
is
need
very high.
other people, right? And also with the people, also with professionals, coming in from an MBA finance, coming in from, let's say, masters in finance or BCom or MCom, or let's say engineering. So you add a variety to your team.
Mm-hmm.
It's so basically, let's say there is a guy who is an economics or a mathematics or statistics background. So his statistics is expected to be stronger than any other people in the team.
Absolutely.
But he may be a disaster in coding,
Yeah.
right? So that gap can be filled in by the guy who is the engineering guy. So if you have these two group of people over there, you know that yes, this is so the team is a whole or more complete team.
Yeah.
Now let's say you are working on a regulation like IFRS 9, and you don't and let's say you have someone who has done CA, so his statistics or his modeling may not be as strong as that of the engineering guy or the statistics guy, but his knowledge of that accounting regulation will be stronger than anyone else in his team. So when you add these three together, you will get a wholesome team which is operating, right, who can take
Add
on
three
any
skills. So
levels of IFRS.
so you said three types of people, right? One, you said somebody who knows statistics pretty well, somebody who knows finance pretty well, and somebody who knows coding pretty well, right? These are the
Who
three
knows
types.
coding pretty well, right. I'm just using an example, Prateek. It's not that only these three are there, but yes, but someone who is working into credit risk is expected to have, or like when they are beginning, right? So it is they are expected to have a basic understanding of at least of a finance or at least a banking works,
Okay.
right? Now let's say I get someone who is of a totally different background, who hasn't been in touch with banking or economics or finance in any way whatsoever. So it just makes things very difficult for that person to work with, right?
Yeah, absolutely.
So
Logical.
that's the reason why you need to have a certain degree of familiarity. And nowadays you have so many these professional modules which are there in place. Now with that you can obviously upskill yourself. Also the respective organizations, they have their own internal training programs, and through training and through the willingness to learn, like, people can always come up the learning curve.
Yeah.
So nowadays it's not that it's a barrier, that your background or degree is a barrier. But
Okay.
one condition which I believe is still there, it's an unwritten law, that if you have not done your master's degree,
Okay.
then it's a bit difficult to get into the domain, because
Is it?
the these people, they have some biases still now. I'm not
Yeah, I
saying that
mean,
that's
it
absolutely a
really
hindrance, but
kind of
the
maybe
basic, at
depends
an
on
entry
the.
level master's degree
Yeah.
is kind of a requirement still now, these days.
I mean, I have seen little different example as well. When we have these companies, large banks and large consulting companies in mid 2010s, 2015, 16, 13, 14, 15, 16, 17. I think these 3-4 years we trained a lot of folks. We helped them build a large pool of credit risk analysts. What we saw was that they actually hired a lot of people who had done BSc in economics, BSc in statistics, BSc in BTech, MCom definitely, masters in commerce or master in finance. We saw those kind of people also being hired because just
So
the
BTech
requirement
is
was.
something, yeah. So BTech is something which is obviously there, right?
Yeah,
Because that's the basic engineering degree, because that's already a 4 years degree.
yeah,
Now, typically, like, you like, if someone comes in, so with the BSc guys, what had happened is that you had the BSc guys, and then they were passed through a formal
yes,
training process to come up the learning curve.
yeah,
But let's say, so the case that I am talking about is mostly, let's say, campus recruitment.
Sure, sure.
So at a BSc level, so if I ask one of these banks or this consulting house to go to a BSc college and do a campusing for risk modeling, they would not be interested to do that. But they'd be interested to go to an engineering college.
Makes sense.
So I'm coming out from that perspective. Obviously, yes, with professional training and with hands-on, anyone can come up the learning, or anyone is free to come up the learning curve. So their degree is not always hindrance.
So I'm going to ask you about two things. You spoke about having quant skills as being one of the primary things to have, and you also spoke about some coding things. So I want to talk about within quant skills as well. Are there some statistical concepts which a person should be very, very strong at as a risk analyst or as a credit risk analyst?
Yeah, so obviously one of the concepts that you need to be terribly strong at is probability theory.
Okay.
So because risk is itself based on probability and
Absolutely.
distributions, right?
Makes
So probability is something that you have to have a very strong understanding.
Okay.
The second thing which comes important is the statistical inferences. So
Okay.
that's testing, hypothesis, estimation, theory, and your sampling distribution. So the very basic concepts.
Okay.
Now these two are the founding pillars of any risk model that you develop, because this determines your data, the way you are sampling your data, the way you are the respective hypothesis that you are forming. So that determines how good or how bad your model is going to be.
Makes
Now, from the predictive modeling perspective, linear regression and logistic regression is absolutely indispensable at this point of time.
okay.
Now, obviously, yes, with logistic regression, there are very in detailed analyses which are done. I'm not going to that, but the person must have a very thorough understanding of logistic regression as a predictive modeling technique. They
Mm.
must have a very clear understanding of linear regression. So when I say linear regression, I don't mean the formula is always, it's not possible to remember the formula, but if I give the formula, the person should be able to interpret that.
And
So
understand
he
what.
must know. Yeah, so if I ask him like, okay, what are the assumptions of a linear regression model? So that person must know that, and he must understand those assumptions, because those are the ones that you need to test. So in theory, what we start off with an assumption are the basic checks that we need to do when we are developing a model, because without that, the final model would not be kind of
Okay.
uh,
So, what
something.
are your favorite questions for testing these skills that you just spoke about? Some of your favorite questions. I'm sure you've been into so many interviews. So, what are your
Yeah,
favorite?
so one of my most favorite questions is that what is the most important assumption of a linear regression model?
Okay.
Because if I ask someone what are the assumptions of a linear regression model, he'll just go blah 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 blah. Now he has to really have a good understanding in order to identify the most important
Which
uh,
what's your answer to that?
assumption of a linear regression model. So obviously the most important assumption of a linear regression model is the non-stochasticity of the independent variable, because that's where everything follows. So once you set that assumption in place, all the other assumptions follow from there,
Great. Some
right?
other questions?
So that's one of the questions, right? So another question, if I'm to talk about linear regression model, is that what is VIF? That's the variance
Yeah.
inflation factor. Okay, so we're talking about VIF, right? So VIF is the variance inflation factor that we talk about, right? The variance inflation factor does what? It helps us identify the extent of multi-collinearity or the linear association among the independent variables.
Yes.
Right now, one of the follow-up question that I have is that what is the formula for VIF? So many of them tell me that okay, it's 1 by 1 minus r square. Now, what is this r square? The maximum cases, the issue that the error the students make is they tell okay, the r square is the goodness of fit of the model, but that r square is not the model r square. That r square is the r square that you obtain from the auxiliary regression equation.
Okay.
What is that auxiliary regression equation? It is that equation which you get by regressing one of the independent variables on the other independent variables. So
So
that's the
from one
catch, right? So
question
when
you bring up multiple
yeah, so
questions.
it's about drilling down and seeing uh what is so where is it that so how to what depth that do they understand these concepts. And linear regression, as a day-to-day method may not be absolutely effective. You have other alternate methods, but that algorithm is absolutely basic, and it's very important to, I mean, it's very useful to screen the the efficiency or the understanding of the candidates.
Makes sense. Makes sense. Something in logistic regression that you like to ask?
So one of the questions in logistic regression which is my absolute favorite is that, are the errors of a logistic regression uh, white noise? I mean, are they normally distributed?
Okay.
Now, the maximum cases, the question they tell me is that no, for a logistic regression, the errors are heteroscedastic in nature. Now, even though, yeah, we do consider it to be correct, but that answer is typically wrong, because the regression that you are doing is a log odds regression. That's not the
Right.
logistic regression. The logistic is that transformation that you are doing. That's a sigmoid transformation on the log odds that you do, which is essentially which we call the logit transformation, and from there it comes regression. The regression that we do is it's a log linear regression equation, and we do it using the maximum likelihood estimation approach. Now, another question that so in industry, when we talk about logistic regression, we often talk about so one of the most important questions that we talk about is the SAS procedures, like the
Okay.
selection equal to stepwise option, what is a forward selection, backward selection, right? Then we talk about the Hosmer-Lemma short test, like what is the Hosmer-Lemma short test, what is Gini, what is case,
Mm-hmm.
why do you need Gini, why do you need case, and what are the checks that you must do in order to ensure that the logistic regression model that you have developed
Mm-hmm.
is a proper model. So how do you assess the variables, how do you select the variables, what are the variable selection frameworks, what is weight of evidence? So there's a whole set of questions that you often get
Right.
to ask in
Mm.
these
Let me ask you
for
another
these sets.
kind of related question here.
Mhm.
So tell me, you mentioned about SAS. So I know SAS used to be the most popular choice up until like mid 2000s for any credit risk analyst,
Mhm.
for any credit risk analysis work. But do you see any shift going towards Python these days?
Yeah,
What's
so
going on?
obviously, yes. Yes, so obviously there is a shift now. So people are moving on, the industry is moving on to Python, PySpark, the open sources, and because they are handling even greater amount of data, huge volumes of data. So that is something, yes, which I would say that there is a clear shift that we can observe. But like unlike the other sectors which have totally shifted onto the open source softwares, banking as a sector is still conservative to some extent.
Okay.
Right. So let's say if I am developing a Basel model, I would always prefer to develop that Basel model in SAS rather than doing it in Python. Or I would try. So what I've seen is banks, so they prepare the data in SAS, they get everything ready, and then they move it, shift it to Python, and then develop it. So the industry is shifting, no doubts on that. But I am someone, who is I'm someone who is a bit old school. So I started off working with SAS, and I really have a soft corner for SAS today. And I seriously believe that SAS is going to stay in the market. Yes, SAS is also evolving as a software,
Right.
but yes, Python and PySpark and R and the other open source
Yeah.
tools are
Absolutely.
a big time skill set to
So
invest in.
tell me, are PD models, probability default model, loss given default LGD model, and exposure at default model, EAD models, are they still famous in the credit risk analyst, in the credit
Yeah,
model?
they will always be
Credit.
famous.
Yeah.
They'll always be famous. They are the most basic set of models that you need
Right.
to develop, because I mean the entire source of risk that we talk about is captured in these models.
Okay.
So your
So
PT model is the most basic model that you can think about. Loss given default, exposure or default model. Yes. So
if
their
if if you were
their
to
framework or
explain,
model.
if you were to explain these models in one line with some simple example, uh, can you do that for our viewers?
So let's say back in my college days, so I used to have these friends, right? So who used to borrow money from you and then run away, and you know that they never would give that money back to you, right? So in that case, the probability of default was 1. So I knew that they would be sure default is not returning back the money.
Okay.
So that was a common information for me.
Okay.
But now let's say I'm giving the money to someone else whom I don't know. So for that, I always need to have an understanding, okay, what are the chances that this guy can give the money back to me, can or may not give the money back to me. So that is your probability of default.
Right.
Now the next question is that from here the next question comes is that, okay, if he does not give the money back to me, what is the total exposure that I have? So what dollar amount or what money value am I exposed to? So
Right.
if I've given 100 rupees to him, and if he pays back to me like after 1 year and I don't charge him anything, so my exposure at default remains at 100, right? So that's my exposure at default. So that's the total amount that I'm exposed to at the time when the account is going into a default. And the third is the loss given default. So now I run after this guy and I go to his house. I make so I ask him, please sir, give back some of my money at least. So he gives me like 30 rupees back. So out of that 100, I get back 30 rupees. The remaining that I have is the loss that I have incurred, right?
Right.
So my
Right.
loss given default is 70 out of 100. That's 70%. So the loss after recovery, whatever I cannot recover,
Mhm.
is my loss given default.
Absolutely. Thank you. Thanks a lot for explaining this so simply. And I can relate with that example that friends running away with your
Yeah,
money.
so because we
Great.
so we all had those friends, right?
Yeah, I'm sure. I'm sure. We all have had. Tanmay, one last question I wanted to ask you here. You spoke about at the beginning of the conversation a lot of regulations coming into the picture. Why do you think the
Mhm.
governments came up with a lot of these regulations, which resulted into a lot of credit risk analyst positions?
Yeah, so the source of this was the 2008 financial crisis, right?
Right.
And once you have seen the havoc that that crisis had brought about, so banks and regulators, governments, they became very cautious about that, right? Because they knew that if something was going to happen, I mean, if I have to bail out my banks every time like things like these happen, then my government is going to go for a toss.
Absolutely.
So that is why it was very important that all regulations be in place and that banks adhered by the regulations. So that is the reason why. So 2008 financial crisis and the the huge financial institutions that we have at those we had at that point of time. So and the very collapse of the two big banks at that point of time and so on. So all of these factors showed the extent of havoc that can be brought about.
Right.
And with that, uh, we started uh, so these regulations became very important so that something of that magnitude does not happen in the future. And even if it happens, we cannot stop it from happening, but we can at least have ourselves insured against such issues so that we can be
So what are
appropriately
the
capitalized.
Yeah. What are the regulations which are currently very, very relevant that you would suggest a young person who's interested in this field to read up upon?
So obviously, the regulations can be understood at two levels, right? So one of them are the capital models. So the regulation that the bank needs to follow for uh, maintaining the capital to answer the question, what is that optimum amount of capital that I must keep with me. So for that you have your Basel models in place, right? So you have your Basel models, your Basel regulation, you have your credit requirement directives, the CRD4 regulation, which is for the Europe, which is followed mostly by the European banks and European markets. And the second set of regulation that they need to know in terms of this is the stress testing regulations,
Right.
the CCAR, DFAS, or the European banking EBA stress testing framework, and so on. So stress testing and capital regulations are the two most important regulations that a person must know who wants to enter into this domain. And the second thing is the provisioning regulations, which is obviously IFRS 9. IFRS 9 is going big time nowadays. That what is the optimum amount of provisions that I need to keep. And
Provisions meaning
then
how much money I should keep with me if something were to
yeah,
happen.
so provision, yeah, so that so basically capital is a component of the balance sheet and provisions form a part of the P&L statement, right? So what I need to understand is out of the profits that I have earned as a bank in my P&L statement, my profit and loss statement, how much of this should be used as a profit or should be kept as a net profit, and how much of should I keep back as provisions. because provisions form a part of the profit and loss statement, right? So the two set of regulations are very different. So you maintain your provisions on a monthly basis. You do your provisioning runs monthly. So, but your capital model runs it on quarterly or annual level. So those frequencies matter
Makes sense.
matter a bit, right? So the two set of regulations are very different, because when you are doing a when you are keeping a provision aside, so you have to have stakeholder happy. You need to give them sufficient dividends. So you need to give them some sufficient part of the profit, or you need to put some amount into your retained earnings. So all those decisions are taken from your net profit, right? So you need to have a way to identify that what is that optimum provision that you need to keep, and the guidelines which help us do that is the IFRS 9 guidelines uh, for those banks who follow the IASB standards, and for the American geographies who follow the GAAP accounting principles. For them, it's a CECL.
Okay, great. Thanks a lot, Tanmay. So you spoke in length about skills required, what kind of companies hire in the credit risk analyst positions, and what exactly credit risk is. And you also spoke about the regulations, the genesis of such a high demand in this field of credit risk and credit modeling, risk modeling. And you also spoke about the specifics, interview questions also that you like to ask, specifically in the while judging somebody in the credit risk analyst positions. And also you gave great examples and explanation of probability to default, loss given default, and exposure at default, PD, LGD, and EAD, the triage of these models that we speak about. Very good examples. And Tanmay, I know you're a busy person, so thanks a lot for taking this time out and talking to us. And hopefully we'll hear more from you. And is there any last suggestion that you would want to give to anybody who's planning to get into the credit risk analyst or credit risk modeler
Yeah.
position?
So for credit risk modeling, like one thing that I would tell everyone, is that who wants to make a career into this, who wants to come in here, is work a lot on your basics, your basic understanding of statistics, your basic understanding of econometrics, and try to understand the basics. Because one thing about credit risk is, especially credit risk, is that that it's very intuitive in nature, right? So you can actually see the entire story flowing in front of your eyes. So it's something that you and I can relate to. So if I'm talking about a credit card or a personal loan, so all of us take a personal loan, right? Rather
Yes,
than, if I talk about
yes,
a Black-Scholes model that may be a bouncer of our heads, right? For people who are from the non-technical background. But for even for a layman or for a person who is not much into statistics and econometrics, they would always understand the challenges that you get from your credit cards, your personal loans, from your mortgages. So these are something that we see every day, right? So it's very important that you have a knack towards credit risk,
yep,
right? That, like one of the thing is, like one of so I've seen a few of my friends and colleagues do this practice. They survey about the banking products from different banking sites, and they try to make a difference between the products that we have in the UK markets, the products that we have in the Middle East market, the products that we have here. How are they different, right? So
yeah.
that adds to an understanding of
Yes,
their
it does.
understanding of how products work, right? And that's the most direct from research that you can possibly do. So so I think having this kind of knack is really important when we talk about this more
Risk.
like credit risk as a career, right? And one of the thing is, you must have a lot of patience to read regulations and write documents, because
Because they
documentation
keep
is a
changing.
very critical portion of it's a very critical portion of credit risk modeling. It's not like in standard data science models that you just develop the model, get the solution, give it to the client, and things are done. So your entire documentation piece, along with your alignments and along with your fonts and everything, so it's a wholesome domain that
Hmm?
it's a wholesome set of functions that we have to perform as a risk modeler end to end. It's exhaustive, it's tough working at times, but that is something I have really enjoyed every moment that I have worked for the
Great.
last 6.5 7 years now. So you
Thanks a
must
lot.
have that.
Thanks a lot for all your suggestions, Tanmay. Great having you here today.
Thank
Thank
you,
you.
Pradeep. Thanks a lot.